Hi everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be talking about index funds. We're going to talk about what they are, the pros and cons, different types of index funds, how to choose the index fund that's right for you, the best types to get started if you're just starting off in investing, where to buy an index fund, and then some common strategies as well as my strategy around what I use them for in my personal portfolio. If you're new to my channel, please consider subscribing. I do videos on saving, investing, as well as stock analysis. Please hit that thumbs up button if you found the information helpful, and let me know what you think about the video in the comments below. So what is an index fund? An index fund is simply a portfolio that's been constructed to match the performance of an index. So that index could be, for example, the S&P 500. Now, for a simple analogy of what an index fund is, let's imagine you're walking into the grocery store. You walk in, and instead of grabbing a cart, walking through the aisles, and throwing each item into your basket, when you walk in the door, you're actually presented with different baskets. And you can't choose what's in your basket. There's already food in there, and you just pick a basket, and you go to the checkout counter, and you can only get what's in your basket. That's essentially what an index fund. There are these pre-packaged investments that already have a combination of securities, different types of securities in them, and you can just grab one basket and you get several different securities within it already pre-packaged for you. Now, before we start talking about pros and cons, I just want to say I love index funds. I'm a big proponent for them. I highly favor them, and I think they're a great tool for almost every investor. Now, on the pro side, they are low cost. You can get some extremely cheap and even on some cases free, like zero cost index funds, which is amazing. From a diversification standpoint, typically when you buy an index fund, you get a fairly good amount of diversification. Depends on what type of index fund you buy, but I'll touch on that a little bit later in terms of the diversification based on type. And then the pro is you're going to be performing at the market. So whatever that market or index is performing at, you're going to be very, very close to that performance level. So with very minimal impact or very minimal work, low cost, you get diversification and market performance. Now on the con side, the strategy doesn't change. The index is really just there to reflect, the index fund is there to reflect what the index is doing, not to change strategy based off of market conditions. It's not flashy, it's not a sexy thing, but it has, back to the pro side, it definitely delivers results at that market performance level. Now on the con side, it rarely outperforms the market, and that's very simple. It's not trying to beat the market, it's trying to stay in line with the market. And so typically if you're staying in line with the market and you have a very low cost, you'll either very slightly overperform or very slightly underperform the market, but very, very close at all times. So it doesn't really stray very far from those index funds. And that's one reason why I personally like them. Now, please, if you like the content thus far, please like the video. It helps me out a ton. Now, back to the video. Next up, I want to talk about different types of index funds. Now, first up, we got the broad market. These typically have large swaths of securities inside of them. Could be bonds, could be stocks, but typically what I think of most commonly would be something like the S&P 500 index, or other indexes such as Dow Jones, NASDAQ. That's what really comes to mind right off the bat. Now, international, this could be essentially most of the time non-US based stocks. So it could be emerging markets, could be European, could be Asian. It just depends on what that index is trying to capture. Now, market capitalization, you have large cap stocks, mid cap stocks, and small cap stocks. So that's what it's trying to capture there. Bonds, you could have different kinds of bonds. You have municipal bonds, state bonds, all kinds of different types of bonds. You could probably get indexes based off of grade of the bond. I don't know much about those, but I'm sure you can do a lot with that. Earnings based, so stocks that have high growth potential, stocks that are deemed to be undervalued. People create indexes for all kinds of things, and growth and value are actually very common to see in index funds. Dividend indexes. Now, this would be really geared towards folks that are looking to get income out of their investment. So consistent income. This probably would either be someone in retirement or someone who is relying on that consistent stream of income off of it. A sector. Now, I've talked about this before. This is essentially when it's trying to match, like, let's say, healthcare or oil and gas or technology. It basically buys companies, for example, that are in that particular industry. And so you can, if you want to get exposure just to that industry, you can buy that index and be exposed to just that sector. Now, leveraged index funds, I don't personally recommend them, but I wanted to include them just for the sake of being complete. Now, these are typically like 2x or 3x leveraged funds. So when you invest in them, if the market goes up 1%, the leverage index would go up 3%. If the market goes down 3% or 1%, the leverage fund would go down 3%. Now, what gets messed up here is these funds reset every day. And so a downturn always does more damage than an upturn. And again, this strategy on leverage index funds is for very, very short-term trading. It's not a long-term strategy. It's for, I would say, to do this, you probably should be a higher level investor with a very active involvement. And that's typically not how I associate index funds. I don't usually associate index funds with a high level of involvement or active trading. All right, so there's a lot of options, lots of different types of index funds. How do you choose the one that's right for you? So I typically go through some very common questions you'll hear me talk about all the time. How long is it? How long do you plan on holding the investment? It's definitely a big consideration. How much risk are you trying to be exposed to in the investment? Third would be cost and fees. How much is it costing you annually, monthly? Is the brokerage costing you money? Is the fund costing you money? What are all the fees involved? That is definitely important. And then lastly, does the investment fit within your overall strategy and the goals of what you're trying to accomplish with your investments? Now, let me talk about some of my favorite types of index funds. Now, I personally favor S&P 500 index funds. I think the S&P is fairly diversified. They move companies in and out based off of different circumstances, and so I like that. And it has decent returns compared to other indexes, and it's a very good index just in general. Now, as you can see on here, I have asterisks next to the funds that I own. And you might ask me, okay, hey Frank, why do you own multiple index funds of the same index type? Well, the simple answer is they're all in different accounts, and those accounts can't be combined. So they're in different retirement accounts or brokerage accounts, and in those accounts, I only have access to a very limited amount of investments, and I choose the one that is best for that particular account that I have access to. So again, you may look in your retirement account, you may look in brokerages pretty much have access to everything. You may look into your retirement accounts, your 401ks, and just notice, hey, I don't have access to any of these. You need to find something that is very similar if you're looking for one of these types of funds, and that's how you would go about choosing it. I also included growth because I think that's good. Emerging markets is also something I support to as a percentage of my overall portfolio, as well as value indexes as well are pretty pretty good, depending on what you're getting and as long as it's low cost as well. All right, so where do you buy an index fund? Well, there's two basic ways. Typically, it's either in a retirement account or it's a brokerage account. So in your retirement accounts, again, I've said this before, typically limited amounts of securities you can buy. You need to find, if there are indexes available, which there typically are, find the one that matches your strategy the best. And inside of your brokerage account, you have pretty much access to hundreds, if not thousands, of securities and index funds, mutual funds, you name it. So you can definitely get index funds in both of these accounts. You just have to find the index that's right for you in those respective accounts. Last up, I want to talk about strategy. So you should definitely develop your own strategy. Make sure that you have something that's systematic, something that you can do consistently, and work that into your savings rate and your budget and how you invest. Now, personally, my strategy with index funds, since I believe, and specifically S&P 500 funds, is a buy and hold strategy. I purchase X percentage every month, and I purchase that consistently and over a period of time. And it's done fairly well for me over time. Please consider subscribing, like the video if you found it helpful, leave any comments down below. Thank you so much for watching. Frank Finance out.